Most Americans think they understand their credit score. But what if the biggest damage to your financial future isn't coming from missed payments or maxed out cards, but from silent, invisible factors you don't even realize are hurting you? In 2026, credit scoring has evolved far beyond what most people learned a decade ago. And the truth is, people with decent incomes, stable jobs, and even good financial habits are watching their scores stall or drop for reasons they can't explain. Imagine doing everything right, paying your bills on time, keeping your balances low, and still getting denied for the best interest rates or premium credit cards. That frustration isn't random. There are hidden credit score killers quietly working against you, and most Americans are completely unaware they even exist. To understand what's really happening, you first need to realize that your credit score, especially your FICO score, is no longer just a simple reflection of whether you pay on time. It's now a behavioral profile. Lenders are analyzing patterns, consistency, timing, and even how you interact with your credit over time. One of the biggest hidden killers in 2026 is something called inconsistent utilization behavior. You might think keeping your credit card balance low overall is enough, but if your usage fluctuates wildly month to month, it sends a signal of instability. For example, spending $501 a month, then $3,000 the next, even if you pay it off, can actually hurt your score. The system interprets this as unpredictable financial behavior, which lenders associate with higher risk. Another silent problem is the way people time their payments. Most Americans believe that paying their credit card bill before the due date is all that matters, but what actually gets reported to credit bureaus is often your statement balance, not your payment activity. So if you're maxing out your card during the billing cycle and then paying it off before the due date, your credit report may still show high utilization. In 2026, this has become even more important because scoring models are more sensitive to utilization spikes. That means even temporary high balances can drag your score down, even if you never pay interest. There's also a growing issue with what experts call credit stagnation. This happens when people avoid using credit altogether, thinking it's the safest move. But in reality, not using your credit cards or accounts can slowly weaken your profile. Lenders want to see active, responsible usage. If your accounts go dormant, your score can actually drop because there's no recent data proving you can manage credit. It's a paradox that confuses a lot of people. Playing it too safe can be just as damaging as being reckless. Another overlooked factor is the rise of buy now, pay later services. These platforms exploded in popularity, especially among younger Americans, but many users don't realize how they interact with traditional credit systems. Some of these services now report to credit bureaus, and missed payments can hurt your score just like a missed credit card payment. Even when payments are on time, frequent use of these services can signal financial strain, especially if you're juggling multiple short-term obligations. Lenders see this pattern and may interpret it as overextension, even if you feel in control. Then there's the issue of hard inquiries, which most people underestimate. In 2026, lenders are paying closer attention not just to how many inquiries you have, but the context behind them. If you're applying for multiple credit cards, personal loans, or financing options within a short period, it creates a narrative of urgency. Even if each individual inquiry only drops your score slightly, the overall pattern can make you look desperate for credit. This is especially damaging when combined with other subtle factors like rising balances or reduced account activity. One of the most surprising hidden killers is something called credit mix imbalance. You've probably heard that having a mix of credit types, like credit cards, auto loans, and mortgages, is good for your score. But in 2026, it's not just about having a mix, it's about how balanced that mix is. If your profile is heavily skewed toward one type of credit, like multiple credit cards with no installment loans, it can limit your score potential. Lenders want to see that you can handle different types of financial responsibility, not just one. Another growing factor is the age of your accounts, but not in the way most people think. While having older accounts is generally beneficial, closing old accounts can quietly damage your score by reducing your average account age and total available credit. Many Americans close cards they no longer use, assuming it's a smart move, but this can backfire. In 2026, scoring models are even more sensitive to these changes, especially if your credit history isn't very long to begin with. Data accuracy is another major issue that flies under the radar. Errors on credit reports are more common than people realize, and they can have a serious impact on your score. Inaccurate late payments, duplicate accounts, or incorrect balances can drag your score down without you even knowing it. With the increasing complexity of financial data sharing, these errors are becoming more frequent, not less. Yet most people rarely check their credit reports unless something goes wrong. There's also a behavioral trend that's quietly hurting millions of Americans, and that's emotional spending patterns. While this might not show up directly as a category in your credit score, the patterns it creates absolutely do. Sudden increases in spending, frequent balance transfers, or reliance on credit during certain times of the year can all signal instability. Advanced scoring systems are picking up on these trends, and they can subtly influence how your score is calculated. And then there's one of the most dangerous misconceptions of all, believing that once you reach a good score, you can stop paying attention. In reality, maintaining a high credit score in 2026 requires ongoing awareness and strategy. The system is dynamic, and small changes in behavior can have a bigger impact than ever before. What worked 5 years ago might not be enough today. So what does all of this mean for you? It means that improving and protecting your credit score is no longer just about avoiding mistakes. It's about understanding the hidden signals you're sending to lenders every single month. It's about consistency, timing, balance, and awareness. The people who win in this system aren't necessarily the ones who earn the most money, but the ones who understand how the system actually works. As you move forward, take a closer look at your own habits. Not just whether you're paying on time, but how you're using credit, how often, and how consistently. Check your credit reports. Monitor your utilization throughout the month, and be intentional about every financial decision you make. Because in 2026, the biggest threats to your credit score aren't the obvious mistakes you can easily fix. They're the hidden patterns you never knew were there. And here, where things get even more interesting, because in 2026, your credit profile doesn't just live in isolation anymore. It's increasingly being evaluated alongside alternative data that paints a broader picture of your financial behavior. While traditional FICO models still dominate lending decisions, many lenders are now quietly layering in additional signals like subscription payment history, rent payments, and even cash flow consistency from your bank accounts. This means your financial life is becoming more interconnected than ever before. If your income comes in irregular bursts, or your account balances swing dramatically throughout the month, it can indirectly influence how lenders perceive your stability, even if your credit report looks clean on the surface. Another hidden factor that's catching people off guard is authorized user relationships. For years, people have used authorized user status as a shortcut to boost their credit, and while it can still help, it can also hurt if not handled carefully. If the primary account holder starts carrying high balances or misses payments, that negative activity can reflect on your profile as well. In 2026, lenders are also getting better at identifying when authorized user accounts are being used artificially, and in some cases, they may discount their impact altogether. So what used to be a simple hack is now a double-edged sword that requires much more caution. Then there's the growing role of automation in personal finance. With auto pay, budgeting apps, and AI-driven financial tools becoming the norm, many Americans have taken a more hands-off approach to managing their credit. While automation can be incredibly helpful, it can also create blind spots. For example, if auto pay is set to cover only the minimum payment, you might unknowingly carry higher balances for longer periods, increasing your utilization and interest costs. Or if an automatic payment fails due to insufficient funds, it can result in a missed payment that damages your score. The danger isn't the technology itself, it's the false sense of security it creates. We also need to talk about something that feels small but has a surprisingly large impact, and that's credit limit decreases. In uncertain economic conditions, lenders sometimes reduce credit limits without much notice. When that happens, your utilization ratio can spike overnight, even if your spending hasn't changed. Imagine having a $5,000 limit with a $1,500 balance, and suddenly your limit drops to $3,000. Your utilization jumps from 30% to 50% instantly, which can drag your score down. This is one of those hidden credit killers that feels completely out of your control, yet it can have real consequences if you're not paying attention. Another subtle but powerful trend is the increasing importance of payment timing within the billing cycle. It's no longer just about paying before the due date, but also about when your balance gets reported. Some financially savvy individuals are now making multiple payments throughout the month to keep their reported balances consistently low. This strategy, often called credit cycling, can help optimize your utilization, but if done excessively, it can sometimes raise red flags with certain lenders. Again, it's all about balance and consistency, not extremes. Let's also consider the psychological side of credit behavior, which is playing a bigger role than ever. Financial stress, lifestyle inflation, and social pressure can all influence how people use credit, often in ways they don't fully realize. Maybe it starts with a few extra purchases to keep up appearances, or relying on credit during tight months with the intention of paying it off later. Over time, these patterns can lead to higher balances, more frequent usage spikes, and a gradual decline in your credit profile. The system doesn't just see numbers, it sees patterns, and those patterns tell a story about your financial discipline. And one more thing that's often ignored is how quickly your credit score can change. Many people think of their score as something that moves slowly over time, but in reality, it can shift much faster than expected. A single high balance reported at the wrong time, a sudden drop in available credit, or a missed payment can cause a noticeable drop within weeks. On the flip side, positive changes can also take time to fully reflect, which creates a frustrating imbalance. This is why awareness and consistency matter so much. You can't afford to check your score once every few months and assume everything is fine. All of this leads to a bigger realization, and that is your credit score in 2026 is less about isolated actions and more about the story your behavior tells over time. It's not just whether you pay your bills, but how you manage your financial life as a whole. Are you consistent, predictable, and disciplined, or are there patterns of volatility and risk? That's what lenders are really trying to understand. So if you truly want to protect and grow your credit score, you need to shift your mindset. Stop thinking of it as a number you react to and start thinking of it as a system you actively manage. Pay attention to your usage throughout the month, not just at the end. Be strategic about when you apply for new credit. Keep your accounts active but controlled. Monitor your reports regularly and don't ignore small changes that could signal bigger issues. Because at the end of the day, the people who succeed financially aren't just the ones who avoid obvious mistakes. They're the ones who understand the hidden rules of the game and use them to their advantage. And now that you know what most Americans are still ignoring, you're already one step ahead.